What's going on? Welcome to my channel. I am the covered call guy. On this YouTube journey, my goal here is to create $120,000 in annual passive income using covered call ETFs. Right now, my projected annual dividend slash options income is about $82,000 a year, 6.8K a month, 1.5K a week, $226 per day, and hourly $9.42. Subject to change, of course. I will be updating this at the end of every month, showing my portfolio holdings, buys, sells, or whatever I'm holding for cash. Or if I didn't buy anything this month, I will be updating that at the end of every month for those who are asking, for those who are new. And of course, hopefully, certain payouts being cut, certain payouts being raised. Hopefully, my projected annual dividends and option income didn't fall too much. All right, so that's the goal here. Try to buffer out and see how much it dropped by or how much it just leveled out by. Legal disclaimer before I start: this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice, because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, guys, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, let's talk about a very discussed cover call on my channel and in general, and talked about pretty much everywhere, right? It is JEPI, and I'm gonna say JEPI is the king of stability, right? It's surviving max drawdowns. Simple breakdown right here. What I'm really gonna talk about, I'm just gonna show you the ultimate strategy for 2026 in terms of JEPI, right? Most people will panic when the market crashes. I'm showing you how to build a portfolio that actually pays you to stay calm, and JEPI is part of that strategy, right? The verdict here is to always wear the crown, we're the best, we're the kings of kings, and JEPI fits this goal. I know I talk about JEPI a lot in terms of like the tax inefficiency and how it might not belong in your portfolio if you're very tax aware and conscious, right? But JEPI, right, for the most part, if you're okay with it, JEPI should belong in your portfolio, because I really think it is one of the king of stability in terms of the income field. So let's get started. All right, so how do we all sleep like a baby while the market burns, right? That's the whole point of the goal. We don't want to worry, right? So looking just at the 2026 financial environment is just pure uncertainty right now. Let's just say how it is, right? Well, the ending of 2025 going to 2026 is just been pretty wonky and pretty not calm, or in a way that we're not really sure of where the market could go down. Of course, there could be larger drawdowns coming in the near future, right? So JEPI does minimize instability for my money, and that's the whole point of my channel. I like to buy things that are pretty stable, sustainable, survivable, durable, right? Reliable, consistent. All right, simple breakdown is I don't want to gamble with my future, right? 2026 is already a mess of changing interest rates, overpriced stocks, right? JEPI is pretty much my insurance policy here. That is what is going to do me for my portfolio, okay? It still lets me participate in the market. So the goal here is absolute consistency. Let's look at JEPI's three structural pillars, okay? The first one is lower equity volatility, right? JEPI is built to move less than the market. That is great, right? There's no more violent 5% swings in a single days, okay? So pillar number two is reduced drawdowns, right? When the market falls 20%, I need to engineer my portfolio to fall significantly less. JEPI plays a part in that. And the third pillar is high persistent income, right? Regardless of the interest rate, this machine generates structural cash flow every month, right? The breakdown here is, think of it like this, right? I built a house that doesn't shake during an earthquake, right? And better yet, the house still pays me rent every 30 days without fail, okay? We need the structural advantage. I just made a video about this. Please, if you haven't watched it, please watch it. All right, stop chasing melt-ups, right? I don't use JEPI to double my money in a month. I use it for controlled participation. What does that mean? I capture a majority of market upside. I also absorb significantly less downside, right? I use systematic options, premiums, harvesting. The breakdown of this is I'm okay with not being the biggest winner in the bull market if it means I'm not the biggest loser in the bear market, right? It's about staying in the game, okay? Participation over growth here, okay? We are income investors. If you're looking for pure growth, then then JEPI might not be the one for you. All right, what about surviving the concentration crash, right? JEPI had a max drawdown of negative 13%, right? So that means it's showing us JEPI's low beta construction and diversified exposure cushioned my capital more effectively than the S&P 500 ever could, okay? So this happened in April 2025 when big tech stock crashed, right? Most investors saw the portfolio drop anywhere from 20 to 30%. Because I was in JEPI, I only felt a fraction of that pain. My capital was preserved while others were wiped out. This is the proof of capital preservation. So if you're very big on that, JEPI deserves a spot in your portfolio. Let's look at my battle plan for 2026 pivot. All right, we have to look at the interest rate pivot, right? The Fed is easing right now. T-bill yields are dropping to about 3%, and I do see my income friends panicking over reinvestment risk, right? My bond substitute. JEPI pays me from stock volatility, not coupons. I'm filling the income vacuum without taking on duration risk. I don't want duration risk that bonds has. All right, the simple breakdown, easily think of it this way. When the bank stops paying high interest rate on your savings, you have to move your money somewhere. You want to make as much as you can, right? Most people would go to bonds, but if inflation does come back, bonds will lose value. This is where I go to JEPI because it keeps paying me even if the rate drops, right? Reinvestment resilience. That's what JEPI is has a factor in too. All right, let's look at monetizing market fear, right? So looking at 2024, it was pretty calm, with 2025 with rising volatility, and then 2026 kicking in with fear spiking. Looking at this chart, simple breakdown is I actually get a higher paycheck when people are scared. Why? Because JEPI sell options, and those options cost more when the market is jumpy. So while others are crying about the news, right, we're all collecting bigger premiums. The rebuttal is, of course, the VIX is my friend here. All right, countering the magnificent danger. What does that mean? Well, diversification as a weapon. I do see the S&P 500 is structurally fragile due to tech concentration, right? JEPI limits individual holdings to about 2% of the portfolio. What does it mean for us? If you hold JEPI, right, if Apple and Nvidia crashes tomorrow, the whole S&P 500 goes down with them, right? But I'm diversified. If tech crashes, my healthcare and industrial stock keeps me steady. I'm not putting all my eggs in one basket, right? That's the objection here, is concentration is a risk. Be very wary. All right, demystifying the black box. What is it? It is the equity linked notes, ELN engine, right? So the structure of this is that JEPI buy notes from banks, right? So this gets me income without complexity. And it also gives me laddering. JEPI staggers expiration every week, right? So this smoothed out my monthly income. Well, what is ELN? Well, think of it as a contract where big bank says we'll pay you a fee every week as long as the market stays relatively stable, right? JEPI collect those fees and passes them to me as a dividend check, right? This is what we call active management part here. All right, so let's look at the global bank counterparties, right? We talk about the good. Let's talk about the bad. This is part of the bad here, okay? The counterparty is most institutional banks. That's what it is. That's the risk here, right? Canadian tier 1 giants, European global SBIs, SIBs, US financial leaders, and global counterparty rosters, right? So although we're not dealing with small risky banks, and I only do business with the too big to fail global institutions, right, it is an extra layer of safety for my money. However, these are still considered counterparty risk, right? Something could happen. It doesn't mean, yes, they are considered too big to fail, but it doesn't mean they cannot fail. Look at 2008, right? And the recent in 2022, 2023, a big U.S. bank did fail, right? So a lot of regional banks could fall, which could lead to a domino effect, right? So, but for the most part, the argument here is credit diversification. Okay, my lunch pails steady stock. What does it mean? Simply quality over hype, right? We don't want to buy the hype. We want to buy the quality. That means JEPI's active equity core is not the S&P 500. It is a curated basket of about roughly 110 to 130 stocks with stable earning, okay? I highlight that part, stable earning. The top holdings are TT, ABBV, PGR, MAV, NEE. Okay, simply breaking down, I'm saying I own companies that people use every day, no matter what, right? People still need medicine, electricity, right? And they still need to use credit cards. These are boring, but boring stays in business. For those who are new, We love boring. Boring is beautiful, right? The goal here is build defensive vote tilt. Okay, let's look at the 2025 to 2026 scorecard. All right, so I'm gonna be comparing it to the SPY, right, the index, and QYLD, which is not a passive. Look at early 2026, right? The market is struggling about roughly basically 0%, right? But I'm already up 4%. Why? Because while everyone is waiting for stocks to go up, I'm already getting paid for my option premiums. This is considered growth. For those who saying I want pure growth, this if your NAV went up plus you got paid, is that not growth, right? The verdict here is performance consistency. It's proof right here. You see it. Actual growth. All right, how does it quantify the smooth ride? We have to look at the beta, right? So it's about 0.54 to 0.59. All this means simply is beta is market speed limit. Just think of it that way. That's easier to understand, right? Measures how much you move versus the index. If you go 1 for 1, you go up as high as the index and go down as low as the index, right? So if you're 1.1, you go 1-1 with it. If you're above 1, then you're even more volatile. But if you're below the 1, which is the standard, you are less volatile. Look, it's pretty much like 50-40% less, right? That's great. That's why it's stability here. Let's look at the Sharpe ratio, right? This essentially is about 0.72 to 0.81. What does it mean? Think of Sharpe as efficiency score, right? Return per unit of risk taken. And the Sortino is 1.33. This is the downside defense, right? Only tracks the bad drops. And this is proof, right? JPMorgan volatility is about 6.24. Actual facts here. SP 500 volatility is about just say 11%, give or take, right? This is facts here. This is proven data, okay? Beta means I move 40% less than the market. Sharpe means I'm making more money per unit of stress, right? So Sortino is the most important factor here because it shows I'm ignoring the good volatility, which is stocks going up fast, and strictly focusing on protecting you from the bad volatility crashes. So you can even have JEPI as a hedge, even though it doesn't actually do hedging, but because of the way it's built, it's like a natural hedge, all right? It's a risk adjusted elite cover call ETFs, in my opinion. All right, double the treasury yield. Well, if you're into T-bills, well, look, JEPI has an 8.33% current annual yield, right? Basically, JEPI pays you 8.3%, while the bank only pays you roughly 4 if you're lucky, right? Maybe 3 in the threes now, right? I'm basically making more than double what the safe government bonds or your high yield savings account or whatever CDs you have, right? I'm letting my money work twice as hard as everyone else. This is important. I mean, at the end of the day, if you are an income investor like I am, I mean, I would assume so. If you're on this YouTube channel and you've subscribed, if you're liking the, my videos, I'm assuming you're an income investor. All right. So basically, if you have your money into a 4% whatever you have T-bills, savings account, right? Why not just put into JEPI? That's the question I'm asking you guys right now. Why not just put into JEPI, right? The goal here is high yield domination. Why are you not doing this? Okay, let's look at the income budgeting reality. That just means the variability swing. JEPI's monthly distribution does change, of course, right? We depend on premiums. So in 2025, they swung from anywhere from 0.33 to 0.54. That is a 66% fluctuation, right? That is the good, that is the ugly, that is the beautiful. I'm telling you everything, which is hence why I started this video. Hopefully, my drawdowns are not too bad, but the next month could be good, right? February might be my low month, and then March might, be my high month or recovery month, right? So let's look at this. Some months check is huge. You have to acknowledge this as income investors, right? And some month is smaller. It depends on market fare, right? I don't spend every penny as soon as it hits. You never do that. I always say, at the end of every month, you should be saving 10-15% as if it was a check, right? Just for tax purposes, right? So I save a little during the big months to cover the little ones, right? It's like it's essentially being like a freelancer with a fluctuating income, and that's how you should see yourself. That's how you protect yourself. And of course, at the end of every tax year, when all your taxes are done and you have something left over, reinvest, and that's all you can do. Every year, you got to increase your income, right? Budget for fluctuations. That's how you should see this. Let's look at my taxable brokerage battle plan. Of course, I'm assuming most of you guys have a taxable brokerage like I do, right? So what is the basic survival guide for high tax tracking in the case that we are in a very high tax bracket with ordinary income, all right? So Uncle Sam does treat JEPI's income as ordinary income. All right, so my tax reality is about an 8.2 nominal yield, drops to about 5.16 after taxes. Yes, it's sad, right? You do have to accept this drag as the cost of stability, right? Yes, I pay more taxes on this than regular stocks, but I'd rather have a 5.16% in cash in my pocket than 0% from stocks that isn't moving, right? I use losses from other bad stocks to cancel out these taxes. It's essentially called tax loss harvesting if you want to tax loss harvest. All right, we don't ever forget, right? Income is the goal here. All right, let's look at JEPI's kingdoms under siege, right? So yes, the counterpart here is JEPQ, which is the NASDAQ growth. It is a little bit more riskier with a higher yield. Of course, it's very tech oriented. And let's look at SPY competitor, right? It is very tax efficient and looking at a peer dividend growth of SCHD. There are other options out there, right? JEPQ is for the tech lovers, SPY is for people who hate taxes, and SCHD is for the long-term builders, for those who just want to have some income every other quarterly with you're not expecting you want to work 20, 30, 40 years. SCHD is built for that. Nothing wrong with that. That's just how some people are, right? But I picked JEPI because I want absolute safest cash flow possible, right? Right here is just know your tools, right? You can own all three, you can own all four. It doesn't matter, just as long as you know how to build your cores around each other. All right, let's look at the psychological alpha. What is this? It's just a cushion factor, right? Investors do feel the pain of losses twice as much as joy. It's a factor, right? JEPI's monthly cash flow, right, is my psychological cushioning, right? When the news says the market is crashing, because I have such a stable portfolio, I don't panic. Why? Because I know a dividend check is coming in a few days, right? That cash helps me stays calm and prevents me from making dumb mistakes like selling at the bottom. This part is just on you. There's nothing that can change this, right? It's your behavioral fortitude. That's on you as an investor. And that's no one can help you improve but you. This is where you're taking a stand here. All right, let's reframing market risk, right? Let's look at the yield spike. If JEPI's price drops, yes, my yield on cost rises. This reframes a loss into a buying opportunity though, right? So when the price goes down, most people think I'm losing money. Nope. I'm actually going to think JEPI is on sale, right? I would love to buy these great income stocks on sale. What that means for me, a lower price means my dividend yield actually gets bigger every new dollar I invest. I love a good sell, right? Asset allocation discipline here. Let's look at the zero duration asset. This just means it's 400 basis points spread over 10-year bond, right? So I mentioned this before. I'm making 4% more than the standard government bonds as of now. So unlike bonds, my portfolio doesn't lose value if interest rates suddenly go back up. It's a safer way to get high yield, right? Total return alternative here. In this type of environment, I guess for those who like SCHD would buy bonds too. I guess those are the same correlation here, but I think for the younger generation, bonds are just too risky. I don't think you can make it out with bonds here. So winning by losing less, right? That is actually the name of the game, right? JEPI upside capture is about 50%. JEPI downside capture is about 60%, right? I catch half of the market gains, but I only feel about half of the market's drop, right? So this is what we call asymmetric defense, right? It's how you stay wealthy long term. You don't need to win every battle. You just need to not lose all your money. That is true, right? This is the part of the defense here. All right, let's look at the unmatched consistency, right? So this is actual data, actual historical data. 5 out of 6 years since inception has been positive for JEPI, right? JEPI has never experienced a double-digit annual loss, okay? JEPI has about a 5-year track record of winning. Even in 2022, when everybody lost about 18%, JEPI only lost 3%, right? It's not about having those disastrous years that set your retirement back by a decade. This is actual proof of elite performance frequency from JEPI, right? So this is not a yield trap for those who are asking. For those who are new, this is not a yield trap, right? So a definition of a yield trap is a fund that pays you dividend using your own money. JEPI does not do that. The money comes from real stock dividends and real option trades, right? It is legitimate profit being shared with you, okay? earned versus fake yield. I have multiple videos about that. If you're new, please go back and watch them. Very educational, informative, and it would make you a better income investor. All right, let's look at the yield volatility roadmap here. All right, so normal volatility, I would say in a VIX of 15 to 20, right? Standard operating environment, right? Expected yield is about 7.5 to 8.5, right? This is my baseline, right? So this just means when the market is normal, I make roughly about 8% with JEPI. When the market gets scary, I do make more. Right? I make about 12%, give or take. When the market is super calm, I will make less, maybe 6%, right? I'm basically getting paid to wait for the next market move, right? This is the volatility hedge here. As you can see, 6 to 8, 8 to 12, right, and 12 back to 6. It's essentially staying within range that I like. Right, the myth of NAV erosion. This is always talked about regardless of JEPI, or it's talked about with all income investors, right? Income, stock, and ETFs, right? You're gonna have the detractors claim funds like this will slowly die. I disagree. JEPI's price has actually traded in a stable $50 to $62 range band for about 5 years, right? People will say the price will slowly drop to zero. Well, it's been 5 years and the price had still basically started where exactly where it started, right? Well, pay me 8% a year. The decay isn't happening here. It's actually showing me that it's staying within range of the market, right? It has actual principal integrity here, great structure. All right, let's talk about sequence risk protection. What does it mean? I think JEPI has a 10% yield covered, withdrawal 2 times over, 0 shares sold. The result here is that principal does remain intact. So if you're already retired and need money and you don't have JEPI, I think JEPI is a great lifesaver here. Right, so instead of selling your stock when they're down, which is of course bad, right? You spend the dividend check, right? Your nest egg stays safe while you pay your bills. You never have to touch your principal, right? So the basic underlying here that I'm trying to say is survival over growth. You don't need the growth right now. If you're already retired, just survive. And JEPI does that very, very well for your portfolio. All right, let's look at a hybrid correlation matrix here. So I'm going to be comparing against SPY, bonds, and USMV here. Take a look at it. Do you like what you see? Because basically, JEPI moves with the stock market but ignores the problems of the bond market. It is, in my opinion, is a quite unique hybrid that gives you the best of both worlds without the bond risk. I would say it acts like a portfolio diversifier. I like it. I used to own JEPI and JEPQ. I'll say right now, and I say used to because I sold it to build up my GPI X and GPI Q because it was a small position. I will be adding it back. I mentioned this, a while back. I sold it because at that time I had way too many stocks. I have a video about this, right? Trying to be a target income investor, and now I'm narrowing it down. I'm probably gonna have JEPI instead of JEPQ. I'm too much of a tech oriented portfolio right now, so I am diversifying. Right, so I will be adding JEPI back. All right, so let's back test my survival logic. I'm using 2008, right? JEPI would have outperformed the S&P with a negative 55% drop due to the massive income buffer, right? If JEPI did exist in 2008, it would have saved your retirement. While the market was cutting in half, your dividend check would have been through the roof because people were terrified, right? High IV. This is tested by history. What? Well, let's ask, when does JEPI does fail, right? I talked too much about the good. Let's talk about the bad here. So if the S&P does rip 20% annually, right? We're talking about a really greedy bull run. Market fear does disappear, right? And the VIX stays below 12, right? So I lose if the world does become perfect in a great, crazy bull market. If stocks only go up and nobody is ever scared, right? JEPI in general will look boring and I will make less than the money than the index. Of course, I'm okay with that because I don't believe the world is perfect. It's not going to happen, right? It's going to go up, down, swing, choppy sideways, or go straight down for a while, and then go choppy and then go straight up, right? But this part, know your trade-off here. If this were to happen, I don't think any covered call ETF would be safe unless you have a hybrid that does growth and income. All right, let's look at the definitive stability scorecard. I'm putting against SPY. And look at that. For the most part, besides upside participation, Overall, if safety is your goal, I'm gonna rate JEPI a 9 out of 10. Right? If getting rich fast is your goal, I'm gonna say JEPI is a 6 out of 10. But I pick safety because staying wealthy is harder than getting wealthy. Right? You have to start somewhere. I'm gonna say this is why JEPI is the best in class stability cover call ETF. Right? Stability versus growth, right? You have to define your win here. JEPI is not for wealth maximization. Okay, I'm gonna put this out here. It is not. It is for turning your current wealth into an 80K salary without selling shares, right? JEPI is your king for this, right? Do you want to gamble the next big tech stock, or do you want a guaranteed salary from your investment? If you want the salary, you want JEPI, total return stability. This is the end game. This is what JEPI helps you achieve. All right, this is just the master data appendix that I put together for February 2026. As you can see here, these are the hard numbers, right? If you essentially own JEPI, you're doing better than the market on yield and risk, and I'm losing less when the market drops, right? The math here does not lie. This is fully verified data right here, just so you guys know. Take a good look. And thanks for watching. Subscribe, comment, like for more simple breaks down. All right, I appreciate everybody that is giving me a subscribe here, liking the channel, leaving a comment. I try to read every single comment, and if I don't reply, just know that I do see your comments. I am busy trying to work on the next video, and I'm just trying to put things together, do some due diligence on my own, and try to do one video per day, so it does get a little hectic and busy for me. Thanks for watching, guys. Stay tuned. Catch you guys on the next.